This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachordiz. Thanks for joining us at XM.com. A trial by fire awaits investors today as the latest U.S. inflation report could single-handedly determine whether global markets end the year with a party or a riot. Forecasts suggest inflation cooled further in November, with the yearly CPI rate projected to decline to 7.3% from 7.7% in the previous month. Most of the anticipated improvement in inflation is linked to falling energy prices and companies offering steep discounts to stimulate sales in an environment of weakening demand, according to business surveys. Unless there's a huge surprise in inflation, this dataset is unlikely to affect tomorrow's Fed decision, although it could influence the tone of Powell's press conference. Turning to the dollar, the outlook seems neutral here. Inflation is simmering down, and the Fed will likely shift into lower gear with its rate increases, but that might not be enough to put the dollar in a bearish spiral because most major economies are in worse shape than America's. Wall Street kicked off a potentially explosive week in high spirits. The S&P 500 rose by 1.4%, yet a look under the hood reveals that the situation was not as cheerful as it appears at first glance. Stock market gains were accompanied by a sharp spike in implied volatility and treasury yields, which is a strange tape. It suggests traders are worried about upcoming events sparking a sell-off, but prefer to hedge that risk through options rather than offload their shares, equally concerned about missing out on a massive rally like last month when inflation came in below expectations. Therefore, there is a delicate balance between caution and optimism in the market, with investors trying to hedge by stealth and still capture any upside, covering all bases. This speaks to how uncertain the landscape is. Admittedly, though, downside risks seem to outweigh upside ones. Valuations remain expensive by historical standards, and leading indicators suggest the economy is slowing down rapidly, leaving earnings estimates for next year vulnerable. Recovery in yields yesterday was not enough to boost the dollar, but it did push the Japanese yen lower. Despite an acceleration in inflation lately, the Bank of Japan is unlikely to tighten policy this month, mostly because wage growth hasn't fired up in similar fashion, and the economy unexpectedly contracted last quarter. As such, a reversal in the yen is likely a story for next year. This is today's Daily Market Comment. Thanks for joining us at XM.com.